Have you ever tried to read a candlestick chart? Did you get confused when the prices started going sideways? Or did you get surprised when the prices suddenly started falling down? Then this video is for you. In this video, we will learn about how to read and interpret candlestick charts. We will start our journey to go through 4 major milestones. First, we will get started by understanding the basic concepts. Next, we will learn how to read candlestick charts. After that, we will explore common candlestick patterns. Finally, we will learn how to identify larger trends in charts. Please note that this video is for learning purposes. It is not financial advice. Investing has many downside risks. Please perform additional research before investing and manage risks carefully. Let's start by understanding what is a candlestick chart. A candlestick chart gives us a detailed view of price movement. Each candle shows the open, high, low, and close price for that time period. A candlestick chart helps us understand how price moved during each time period. Let's compare traditional mountain charts and candlestick charts. Traditional mountain charts are useful for seeing the big picture. Candlestick charts are more helpful when we want to study market behavior more closely. Now, let's take a look at the basics of a candlestick. Each candlestick shows the price movement for a specific time period, which could be small or large, such as 5 minutes, 30 minutes, 1 day, 1 week, or even larger. Let's take a look at the different parts of a green candlestick. The thick middle section is called the body of the candlestick. The thin lines on the top and bottom are called wicks. A green candle means the price closed higher than it opened, so when the candlestick is green, the bottom of the body is the opening price, and the top of the body is the closing price for that time period. The bottom of the lower wick is the lowest price reached in that time period, and the top of the upper wick is the highest price reached during that time period. Now, let's take a look at the different parts of a red candle. The thick middle section is called the body of the candlestick. The thin lines on the top and bottom are called wicks. A red candle means the price closed lower than it opened. So when the candlestick is red, the top of the body is the opening price, and the bottom of the body is the closing price for that time period. The bottom of the lower wick is the lowest price reached in that time period, and the top of the upper wick is the highest price reached during that time period. We have achieved the first milestone of our journey by understanding the basic concepts of candlestick charts. Let's continue the journey to milestone 2 by understanding how to read candlestick charts. Now let's take a look at candle colors and candle lengths. On a candlestick chart, each candle gives us important information about price movement. The color of the candle tells us whether the price moved up or moved down during that time period. A green candle means the closing price was higher than the opening price. A red candle means the closing price was lower than the opening price. But color alone does not tell us the full story. We also need to look at the length of the candle body. A short green candle means the price closed only slightly higher than where it opened. This usually shows a small upward move or weaker buying pressure. A long green candle means the price closed much higher than where it opened. This usually shows stronger buying pressure and a bigger upward move. On the other side, a short red candle means the price closed only slightly lower than where it opened. This usually shows a small downward move or weaker selling pressure. A long red candle means the price closed much lower than where it opened. This usually shows stronger selling pressure and a bigger downward move. Let's also take a look at some doji candles. A doji candle happens when the closing price is very close to the opening price. This can suggest that buyers and sellers were uncertain or balanced during that time period. Now, let's take a look at how to read a candlestick chart and understand what this candlestick chart is showing us overall. This example chart shows price movement from around April 15th to July 1st of a hypothetical company for a hypothetical year. The horizontal x-axis shows the dates, so we can follow how the price changed over time. The vertical y-axis shows the price level. In this example, it is starting near $100 and going up to around $128. Each candle represents the price movement for one trading period. Now let's start taking a look at the candles, starting from the left side and going towards the right side. At the beginning of the chart, we can see a clear drop. The price falls from around 118, go down close to the 102 to 104 area by late April. After that, the chart starts to recover. In early May, more green candles begin appearing, and the price gradually moves higher. Around the middle of May, the price reaches the 115 to 116 area, but then it becomes more choppy. That means buyers and sellers are both active, and the price is not moving in one smooth direction. Near the beginning of June, we see a stronger upward move. A large green candle pushes the price higher, showing stronger buying momentum. After that breakout, the price pulls back slightly, but then it continues moving upward again. By mid to late June, the price reaches its highest area near 126 to 128. Then we see several red candles, showing that the price begins to pull back from that higher level. Near the end of the chart, the price starts to recover again, moving back toward the 121 to 122 area. There are often short-term drops, pauses, and reversals along the way. We have achieved the second milestone of our journey by understanding how to read candlestick charts. Let's continue the journey to milestone 3 by understanding common candlestick patterns. Now, let's take a look at some common types of candles and what they can tell us about price movement. First, we see a tall green candle with a large body and almost no visible wick. This means the price opened lower and closed much higher. This type of candle is called a bullish marubozu. It could indicate strong buying activity, with buyers pushing the price up and closing the time period almost at the top of the range. Next, we see a tall red candle with a large body and almost no visible wick. This means the price opened higher and closed much lower. This type of candle is called a bearish marubozu. It could indicate strong selling activity, with sellers pushing the price down and closing the time period almost at the bottom of the range. Now, we see a green candle with a very small body and long wicks above and below it. This means the price moved up and down during the time period, but closed just a little bit above the open price. This type of candle is called a green doji. It could indicate indecision in the market, with buyers and sellers fighting for control, but the price closing slightly higher. Finally, we see a red candle with a very small body and long wicks above and below it. This also means the price moved in both directions, but closed just a little bit below the open price. This type of candle is called a red doji. It could indicate indecision in the market, with no clear winner between buyers and sellers, but the price closing slightly lower. So by looking at the candle shape, the candle color, and the size of the body and wicks, we can start to understand what may have happened between buyers and sellers during that time period. Now, let's take a look at some more common candlestick types and what they could indicate in the market. First, we see a green candle with a small body near the top, a long lower wick, and little to no upper wick. This candle is called a bullish hammer. It could indicate that sellers pushed the price down first, but buyers stepped in strongly and brought the price back up. Next, we see a red candle with a small body near the top, a long lower wick, and very little upper wick. This candle is called a bearish hammer. It could indicate that even though the price stayed near the top, selling pressure appeared during the period, which may be a warning sign. Now we see a green candle with a small body near the bottom, a long upper wick, and almost no lower wick. This candle is called a bullish inverted hammer. It could indicate that buyers tried to push the price higher during the period, and although the price pulled back a bit. Finally, we see a red candle with a small body near the bottom, a long upper wick, and very little lower wick. This candle is called a bearish shooting star. It could indicate that buyers pushed the price up at first, but sellers took control and pushed it back down. Now let's take a look at patterns with multiple candles and understand how a group of candles together can give us more context than just a single candle alone. First, we see two candles. The first candle is red, showing price moved down. Then, right after that, we see a larger green candle, and its body fully covers or engulfs the body of the previous red candle. This pattern is called a bullish engulfing. It may indicate that buying pressure became stronger than selling pressure in that time period, although the next few candles may or may not show a similar pattern. Next, we again see two candles. The first candle is green, showing price moved up. Then after that, we see a larger red candle, and its body fully engulfs the body of the previous green candle. This pattern is called a bearish engulfing. It may indicate that selling pressure became stronger than buying pressure during that time period. Now, we see a sequence of three candles. First, there is a large red candle showing strong downward movement. Then, there is a much smaller candle showing hesitation or slowing momentum. After that, we see a large green candle showing that price moved strongly upward. This pattern is called a morning star. It may indicate that bearish momentum is weakening and buyers started stepping in, although the next candles may or may not follow the same pattern. Finally, we see another three-candle sequence. First, there is a large green candle showing strong upward movement. Then, there is a small candle showing hesitation or loss of momentum. After that, we see a large red candle showing that price moved strongly downward. This pattern is called an evening star. It may indicate that bullish momentum is weakening. Sellers are taking control during that time period. So, when we look at multiple candles together, we can often get a clearer picture of shifting momentum and possible trend reversals in the market. Please note that these patterns are for an overall analysis and understanding of what the candles mean. The next few candles may or may not follow the established pattern. We have achieved the third milestone of our journey by understanding common candlestick charts. Let's continue the journey to milestone 4 by understanding how to identify larger trends in candlestick charts. Now let's take a look at support and resistance levels, which are common tools used to observe important price areas on a chart. On this slide, we can see a candlestick chart showing price movement over several months. Near the top of the chart, we can see a red shaded area. This is the resistance zone. A resistance zone is an area where the price may struggle to move higher. In this example, the price reaches this upper area multiple times, but it does not clearly break above it. That means sellers may be becoming stronger around that level, or buyers may not have enough strength yet to push the price higher. Near the bottom of the chart, we can see a green shaded area. This is the support zone. A support zone is an area where the price may struggle to move lower. In this example, when the price falls near this lower area, it appears to bounce back up instead of continuing downward. That means buyers may be stepping in around that level, or sellers may not have enough strength to push the price lower. It is important to remember that support and resistance levels are mainly used for observation purposes. Prices do not always behave perfectly around these zones. Let's take a look at doing trend analysis using moving averages. A simple moving average, also called an SMA, takes the average of a specific number of recent prices and turns it into a smoother line on the chart. For example, if the previous 5 days' closing prices were 101, 99, 98, 104, and 105, then the 5-day moving average would be 101.4. By doing this for every day on the chart and averaging the last few days' prices each time, we can create a smoother line that shows the overall trend more clearly. In addition to simple moving averages, some investors also use exponential moving averages, also called EMAs. An exponential moving average still creates a smoother trend line, but it gives more weight to the most recent prices. This means an exponential moving average usually reacts more quickly to recent price changes than a simple moving average. So when the price starts moving up or down more strongly, the exponential moving average may adjust faster than the simple moving average. To use moving averages on a stock chart, it is usually helpful to add 2 or more moving averages. Some investors add a short-term moving average with a duration such as 5 days, 10 days, or 15 days, and a longer-term moving average with a duration such as 50 days, 100 days, or 200 days. This helps us see the short-term trend and the longer-term trend on the same chart. But please note that moving averages are not perfect. Prices can still move above and below the lines many times, so they should be used as a general guide, not as a guaranteed signal. Now, let's take a look at understanding the potential risks while using candlestick charts. Candlestick patterns can be helpful, but they are not always reliable. A pattern may look like it is predicting one direction, but the price can still move the opposite way. Candles also do not explain why the price moved. News, economic events, market sentiment, company updates, and global events can all affect price movement in ways that a candle alone cannot show. Short-term signals can also be misleading. One small candle or one small pattern may look important, but it may just be normal market noise. So candlestick charts should be used as one of the tools, not the only tool. Always review the larger trend, understand the risks, and avoid making decisions based on one candle or one pattern alone. Congratulations! We have completed all 4 milestones in our candlestick chart journey. Thank you for watching this video. I hope this knowledge will help you understand candlestick charts and patterns more clearly. Please like the video and subscribe to the channel for more videos related to investing and finance. Please also leave a comment about what topics you would like to learn next, or any questions you have about candlestick charts or stock market investing. Thanks again for watching, and I'll see you in the next video.